Hello and welcome to this week's installment of Nucleus Investment Insights. I'm Damien Klassen, Nucleus Wealth's head of investments, and I've also got David Llewellyn Smith here, our chief strategist. Welcome, David.
G'day, Damo.
Thanks.
Viewers.
Yes, the topic of the day is an energy crisis inevitable. So obviously we've seen some pretty amazing price movements in energy over the last couple of months, and we wanted to have a bit of a deep dive into that today, looking at the bubble, demand drivers, supply drivers, and what we can sort of see going forward there. But before we start, quick housekeeping. Before we get started, if you enjoy our content and you haven't already, please click the subscribe button. And then you can click the bell notification if you want to be notified when we go live or when we have a new webinar that you can watch. Alternatively, we are on a whole bunch of other podcast platforms. You're welcome to follow us on any of those as well. For anyone listening in lives, feel free to drop in questions along the way in the YouTube live stream chat, and we'll try and get to those as we're going. So with that, I might jump straight into the slides and just looking at the agenda for today. So really what we really want to do is look at the hype, I think, behind the amazing the energy bubble as much as the fundamentals. And so yeah, it's a really bit of a contrast at the start between the hype and then some of the demand supply drivers, and then how we can see these resolved. Dave, I might jump across to you for the first one. So looking
Yeah,
at the amazing
sure.
energy bubble.
Yes. Well, it is amazing. Well, perhaps it's better to say it would have been amazing if it wasn't like bubble number 75 coming out of COVID, because it's been a rolling sequence of them. So this one is probably the most amazing of all. That being said, some of the price movements in energy worldwide have been nothing short of extraordinary and unprecedented. So I could have picked a million charts, but I've just picked one, the best one basically, to give you a sense of it, and that is European gas price, which has gone up over 1,000% over the last 12 months. But I could show you thermal coal's up 450, coking coal 230, oil 100. All of these energies are up, spectacular quantities. Other than oil, they're all at absolute record highs by miles, and that's just the tip of the iceberg. These are just some futures markets. There's the spot markets I could show you, plus various other indices around the world of these different energies, and they've all gone completely nuts. And it's happened very, very quickly. Like, obviously, energy prices have been climbing, but at reasonable kind of rates for much of the last 12 months. But then in the last 3 months, it's just gone completely parabolic.
Yeah.
Uh,
But it is worth saying that the longer term futures are much lower though. So
Absolutely.
yes. So
They're all in very steep backwardation. So
mm,
futures markets are all saying this is very temporary.
yeah. And so
While
actually let me just explain that for anyone who's not sort of on top of the futures market is basically what you can do is you can buy these things for a future delivery date. And so and the prices we're sort of showing here are some of the very near dated deliveries. But if you
Yeah.
go out a year, 2 years, 3 years, these prices fall right back down to current, or sorry, to sort of prior levels based on the
Not
uh,
quite prior levels. That's an interesting point. Um,
mm,
they do fall way back, but to levels that are a bit higher than they were previously, which
mm,
I basically think will pass as well. I think they will
mm,
all fall back to their previous lows,
mm,
but for the time being, there's some lingering, uh, I suppose, traction for the dominant narrative for this, which is actually completely out of step with futures markets, and that is that this is a structural problem in energy, uh, derived from ESG, so environmental, ethical, and various other concerns that are inhibiting supply side investment into energy and
mm,
creating this a structural shortage that means these prices will be high forever. That's the dominant narrative coming out of Wall Street, which is then tipping into all sorts of other things, stagflation, etc.,
mm.
where futures markets are out of step with that because they see prices falling way back, but it has impacted them to the extent that prices are projected to be higher than they used to be. say, in the last cycle.
Yes. Yeah.
I think that's highly questionable as well. So
Mm.
anyway, let's dig into why. Um, so there's four sort of major energy raw materials that are all raging hot. There are others, but these are the big ones. Um, and the two critical components of this is really one trade, and that is they're the raw material input into electricity production, coal and gas. And so on the first leg of that, in coal, it's obviously a huge, uh, by far the most dominant form of Chinese energy. Electricity output is coal generated because basically it has immense coal reserves. Uh, and so its coal demand has gone, really bananas this year. At one point, I think it was up about 16%. Its electricity demand, I should say, has gone bananas this year. So generally you'll see an electricity increase even in a rapidly growing economy of maybe 3 or 4%. This year we saw 16, and so obviously that was a huge demand shock for the Chinese grid. And that sort of landed on top of already depleted coal inventories. But the question is it sustainable? Well, if we look at my two charts I've got up here, is one, the main driver of this huge kind of demand surge for Chinese power is actually exports, and uh, coming a lot very much out of the US and its huge demand side stimulus. So there's a chart here showing you just how far ahead of trend goods demand is in the US, and as it happens, it's about 16%, matching the peak of Chinese power growth earlier this year. It's now down to about 5%, by the way, so it is falling away, or
Mm.
growth is coming back, uh, as it were. And so the first question we're going to ask is this huge spike in US demand going to continue for goods? This is specifically for goods spending. Uh,
Yeah,
so
and it's mirrored around the world, isn't it? In terms of this, is people who can't spend money on haven't been able to spend money on services or travel, and instead they've been spending money on goods.
yes,
And so the question is, does that continue?
yes,
And yeah,
yes,
for us,
which
the
will
answer is it'll
yes, well
probably be.
we'll come back to whether or not it continues, but
Mm.
that's been one of the there is a kernel of truth to what's going on in these energy markets, and that's one of them, where we have had this huge surge in power demand in China. And the second chart I've got up there shows you why it's hit the power grid so hard, and that is the Chinese economy is just fully leveraged to uh, electricity output in it because it's so industrial. Most developed economies, it's industry constitutes perhaps 15% of power uptake. In China, it's more like 60 or 70. So it's just when it's been struck by this big export and external boom, it's been very power hungry, and so that's driven up consumption hugely. So that's your coal story, more or less. Um, on the second, sorry, Damo, you wanted
Well,
to?
yeah, it's worth saying. I mean, so the Mongolian coal as well. So there was some blockages there,
Oh,
and then
these are only the demand drivers.
oh, okay, right,
We'll
sorry,
come to supply.
supply
Um,
demand.
and then the second leg of this is gas, and uh, gas demand's been very strong in Asia for the same reasons, because coal's been short. But the real gas crisis has hit in Europe, and again, there's some weather-related stuff in this, uh, and which helped sustain demand. And boosted it. But the main issues for gas are actually on the supply side, so we'll come back to that in a moment. And the third factor, which has really driven the oil price up, is on the demand side, is US reopening, which is sucked in a bit more oil, and the same globally as other economies have reopened. Demand's still well down on where it used to be. Uh, but it's started to rise, and it has, for the time being, drained US inventories because supply hasn't yet responded as it has in previous cycles, which is a good jumping off point
Mm.
for us to get into the supply
Well,
drivers.
and I suppose on the demand side though as well, you'd also say we don't know for sure in terms of what's going to happen in terms of cars, but there's a reasonable chance that you see a lot more driving and less public transport going forward. So certainly, there's
Well,
been a lot of demand for cars.
that's absolutely the case. Yes.
Yeah,
So
but
oil
but
demand's
on
been
the flip
solid
side
in the
though,
US.
yeah, but on the flip side is we don't know how much working from home offsets that. So if you have 20% fewer public transport trips and 20% more car rides, but then your overall car rides falls because there's more people working from home, then where that balances out, nobody really knows.
Yeah. Uh, I would argue that other than the a little bit of weather and the very large goods demand coming out of the US at the moment, by far the biggest factors in what we're seeing in energy at the moment is the supply side drivers. So, going through our three energies again, and we'll start with coal again in China. I mean, China's just seen an entire kind of I don't know what is the collective adjective for butterflies. Damo, is it a flock of butterflies? I don't know.
Yeah, I don't know.
But we've had a flock of butterflies flap their wings all around the world to create a limited supply of coal for China in the short term. So it's had a bunch of accidents itself, which have triggered a number of closures and inspections and stuff in its major coal producing states. It's had floods in those coal producing states as well. It's had COVID issues with Mongolia, forcing it to shut its borders and reduce a lot of coal imports, especially in coking coal. Some of the weather-related stuff again has hit China in that on the supply side because it's had quite low hydroelectric output,
Yes,
making it.
the places where the floods are is not where you want them.
No,
If you
that's right.
reverse
They're
where
all in the
the
wrong
water is somewhere
places.
else. Yeah.
Exactly right.
Mm.
Uh, and then it's also had a lot of low imports of coal, and for a variety of reasons. There's been some railway accidents in Russia, obviously problems with Australia, just geopolitical problems, but then a bunch of COVID restrictions around the world in other exporters. And so, it's really has been a perfect storm for Chinese coal on the supply side in literally in a million different storms that have all come together to hit it right at the moment that its demand's gone nuts. And so, you know, basic economics gives you the outcome. Um, the European stuff, which is more gas, uh, is less complex and more complex. It's had some low wind output, but the key input in Europe has simply been that Russia has taken the opportunity of tight energy supply globally to really put the squeeze on Europe for a number of reasons. It hasn't built a new pipeline into Europe that manages to circumvent Ukraine, and uh, by doing so, over the long run, one of the current major pipelines coming from Russia into Europe goes through Ukraine, and so if it can build a pipeline around that, it doesn't have to pay the Ukraine anything, and so it increases its margins on the gas it can sell to Europe. Obviously, it could appeal to Europe as well because it might end up being cheaper gas, but then you get into all sorts of complex questions of NATO, Ukraine. Uh, whose sphere of influence does Ukraine operate in? Uh, it arguably at the moment it's half in the EU camp and half in the Russian camp. But if Russia manages to gut its gas revenues, then it's got huge leverage over Ukraine, and it can start to draw it away from NATO and back towards Russia. And so all of these different forces are at play in the Nord Stream 2 pipeline, and this gas crunch that Gazprom has very deliberately foisted upon Europe. It's got heaps of production, Gazprom, but it just simply is refusing to send it to Europe. And so you really have some, I
Yeah.
suppose you'd call
Well,
cartel behaviour going
yeah.
on the supply
They'll,
side.
they'll argue that Russia will argue that that's not the case, but that they need it at home or whatever it is. But you can see from that chart pretty clearly that
Yeah.
It seems to be a very happy coincidence that just as
Well,
they need to um, negotiate this pipeline and get the final approvals to get it flowing, that all of a sudden there's a gas shortage and
yeah.
well, wouldn't this and Vladimir's even come out a couple of times and said, wouldn't it be nice if this new pipeline was up and running?
Yeah,
That'd really
that's
fix
right.
our
Look,
prices.
they're barely containing their mirth, to be honest.
Mm,
I mean,
mm,
they're barely bothering to lie. It's just a case of, you know what you got to do it, and we'll give you the gas.
mm.
Um, so, so that's why the story is simpler in Europe, but it's also more complex because it's not simply an economic decision. There's all sorts of geopolitical calculus that goes into whichever one of when those decisions are made to release the gas and to ease the energy shock. So
Yeah, and the other thing, that you'd have to think is on Russia's mind is, you can push this a certain distance, but you can't push it too far, because if you push it too far, then Europe just says, you know what, this Russian gas isn't reliable at all. Let's import it from let's import it from the Middle East, let's import it from the US, let's import it from Australia,
yes,
and
they
yeah,
can.
and
There are limits to how far they can push it, but I mean
mm,
they are exceedingly dependent on Russian gas. So
yeah,
they don't want to push it too
very much.
far because there are lots of incentives for the Europe to move away from there already.
Mm,
Uh, so that's basically the coal and gas stories. Uh, on the supply side, in terms of oil and depleting US inventories, the US, the last cycle, oil markets, especially in the US, became very dependent on US shale, as we know, and it's always responded very quickly to rising prices in the past, anything above $50, and it started to roll out the rigs and frack some more. This time it has been a little slower to ramp up, looking to sort of return capital to investors rather than borrow more and get into more capex. That is probably a small structural shift in the market, a little bit more capex control. However, since oil passed about $70, the rig count has started to accelerate upwards, and already you're starting to see US output ramp up. And by mid next year, we'll be at the same highs of rigs as, assuming the oil price stays above 70, we'll be back where we were in 2019 before COVID. There'll
mm.
be a little bit of delay on the flow of oil because they've got to rebuild their frac logs, etc. But US output will be ramping pretty happily into mid next year. Uh,
And
and
the other thing to
accompanying,
note is the gas side in the US is that, gas in the US is really a byproduct of,
yeah,
of, of oil. So when they most of the shale oil that they're doing the fracking on has elements of gas in it. Some have more gas, some have less gas, but the oil is a really valuable part, and the gas is sort of like, well, if it's in the past they'd often flare it, so they literally just burn it to get rid of it. Now there's lots of pipelines around. They tend to push it into the pipelines, and there's some places where they've even had negative prices from time to time in terms negative gas prices in terms of people are picking it up. It costs money and there's environmental issues to flare it, so they're happy to just actually pump it into pipelines and even make a small loss, because the oil they're getting out is so valuable. So as the oil picks up, you'll also see more gas production. And it's worth noting that US gas inventories are a little below average, at the moment, but there's been a lot more US exports of gas as well over the last couple of years, and so I guess what I'm saying is that they're managing to keep their inventories not far away from where they used to be, even with increased exports. And so as the oil ramps up again, you'd expect to see more gas exports sort of
that's
coming
right.
on.
And there is an insane gas arbitrage at the moment between Europe and the US. Like the US
Mm,
natural gas price is sitting at about $5. In Europe, it's at, I didn't look at what the latest price was in the chart, but it's it's whatever it is, $100 or something. And yet
mm,
the US could ship that gas to Europe for 10 or 12.
Mm.
So
Y-
this
Yeah,
is something of a lid on what how hard the Russians can push, because the Europeans can turn to pretty good volumes of US LNG, and your Russia, cost Russia market share. So so there should be a resolution for both, and yes, there'll be a lot more US gas coming online, and as we know, they've got a huge LNG export boom underway. They're already closing in on Australian volumes, and they've got just an unbelievable quantity of LNG export plants in the pipeline with approvals. Not all of those have capital and FID, but there's heaps coming on stream.
mm,
Also, heaps of gas coming from Qatar in about 3 to 4 years. So, I mean, the final point to make on supply basically is that there really isn't any ESG constraint. That argument just looks made up to me. There's heaps of energy, raw materials floating around the place, but we have had this perfect storm of demand and supply in the short term. Uh,
yeah. I mean, I wouldn't say made up because there are there's I guess for me I look at it and go there's the big long term projects like if you found an offshore if you found an offshore oil supply and you're looking at do I tap this and then run it down, you're probably talking 10 years or so just to get oil out of the ground, even if you're going really quickly on the whole thing.
mm,
And then you're running it for 30 or 40 years. You're well past 2050 at that point. And some of these things take 20 or 30 years to get up and running. So by the time we've hit net zero at 2050, your oil well will just be coming on. And that's very different though to the short term stuff. So there are some ESG issues playing out in those bigger, longer term projects. But the issue is um, the pauses in that, and that might slow down today, but we're not going to see the supply effects of that for a decade or 2 decades. So
yeah,
it's the decisions that were made 2 decades ago that were making that are determining, or a decade ago that are determining what new oils coming on today.
yeah,
In those big projects, the flip side is the US projects. There's the shale stuff, which turns on and off very quickly, so they can get up and running within a year or two. Um, and often Dave was speaking about the frac logs. A lot of the ones have, effectively drilled it, got it all ready, and then blocked it up. And then when the prices are high enough, they can open it back up again and let it out. That's not as probably not as the volumes there aren't big enough to sort of handle huge swings, but they're certainly at the margin. They're a lot faster to react in terms of those shale. I might
so
I might actually stop you, Dave, for a few questions actually
yeah.
for
Well,
from
let me just add,
okay.
uh, just in terms of the ESG stuff, yes, absolutely. I mean, in terms of today's price action, I don't think it's
Mm.
it's relevant. So anyway, yes, go on.
Okay, so a question from Sasha: Is EU's move from long term to spot contract for gas part of the price problem?
Good lord.
Next,
Long term to spot. Yeah, maybe
yeah,
next.
yeah.
I'm not sure. I can only argue because I don't follow that market that closely in terms of those dynamics. I do follow the Asian market and LNG market pretty closely in that sense, where I would say, uh, would that have been an issue in Asian gas? Uh, Look, to the extent that spot gas has become more popular in Asia and perhaps by analogy Europe, it will be part of what's transpired because you're simply getting more of those price pressures coming to bear sooner. Uh, but I guess the point here is that uh, the uh, the underlying imbalance that we're seeing is a perfect storm of temporary factors. Um, so if we were all on long-term supply contracts, then price volatility would certainly be lower. Yes, and you could possibly argue, therefore, that the future may see more volatile energy prices as spot markets become more dominant. But again, the factors that have driven this imbalance are very temporary, so I wouldn't be overly concerned about it.
Mm. Um, uh, Iron ore. Any thoughts on effects of energy crisis on iron ore?
Absolutely. Uh, so in the short term, and I guess we'll touch on this later, but we can do this now, I suppose. So the price action around coking coal in China has been just drop dead crazy. One of the reasons for that is, or the main reason for that is, as we know, coking coal is a critical ingredient into blast furnace production of steel, along with iron ore. What's happened once this power crisis has hit China is it's responded in part by forcing shutdowns in its industrial economy, the highly intensive, energy intensive areas of its industrial economy, and that includes steel and lots of metals processing. And the But the steel shutdowns have been largely electric arc furnaces. That's where you use most of the electricity, and that's using steel scrap. So that's absorbed some of the steel shutdown or steel output cuts that we've been seeing in China, protected uh, iron ore and coking coal a little um, through from those steel output cuts. Nonetheless, even if you extrapolate from those or include those in your numbers, you still reach numbers something like coking coal demand having fallen away by about 100 million tonnes from peak demand earlier this year to where it is today. And this is just such an astonishing quantity of coking coal uh, to to have, for the market to not need, for the price to be going bananas, is well, let's just call it irrational. I'm going to run out of metaphors for what it really is, but it's highly irrational. Um, so what I would expect to happen is, as China basically, and we'll come to this through the resolution, as China starts to produce more coal and all of the supply side loosens up around the world and it gets more imports, etc., and the prices crash, then that EAF production that's been cut, the steel production, scrap steel, is all going to come back on stream. And it's a huge quantity. It's like 120 million tons of steel. And so if the steel cuts remain in place, then you're suddenly going to have an enormous surplus of both iron ore and coking coal. And so I expect, excuse me, I expect ultimately there is another macro dimension to this, but I probably shouldn't get too sidetracked. I think ultimately this energy bubble will be very bad for iron ore. I'll quickly tell you the other part of it. Right now, China's growth has stalled completely on its property crash and its energy shock, because the energy shock has caused it to cut a lot of its metals processing, as I said, and that's hit industrial output. But as the energy crisis eases, is going to ramp up all that stuff again, and so it'll get better growth for a quarter or two as it starts to ramp up all that energy processing as coal deflates. And so it has no need necessarily to intervene for property, because its growth will be reaccelerating in industry. And so again, you're going to see like a, a and property being such a huge demand driver for iron ore and coking coal, then I see basically nothing but downside for iron ore. And I think the energy bubble potentially makes it worse for those two reasons: the distortions from EAF, and then the distortion from cut steel and rebounding steel, and how those two things work together, or
Mm.
cut Chinese growth and rebounding Chinese growth. So I hope that
Well,
wasn't too long-winded.
let's jump onto the paths of resolution. We'll hold off the other questions until, yeah, because I think some of those might be partly answered.
Okay, so where we are now is we've had a perfect storm. It's depleted inventories everywhere, owing to both demand and supply side impacts. And we're going into the Northern Hemisphere winter, which is the highest period, obviously, of energy demand for heating. And we also we're on the verge of a La Nina, which throws a real spanner into the works of traditional energy patterns. It doesn't necessarily mean a colder winter. It kind of just makes winter a bit more volatile across the Northern Hemisphere. In net terms, it might even be a little bit better, but it changes the patterns of it. I guess is the key question. But it does other things on the supply side. Like, for instance, there are a lot more cyclones around Australia. And some people may remember, I think it was 2011, 12 when we had Cyclone Yazi. That was a La Nina event, and it just flooded all of Australia's coking coal mines in Queensland, and they were shut down for months. And if you had something like that now hitting these markets, then they'd make today look, positively sane. So there is this next few months where we go into the northern winter with depleted inventories and possible weather effects. You cannot discount the possibility that this gets like spectacularly worse, even though it is actually starting to resolve. If we have a little weather shock that comes in, it will be a big problem for markets, and they'll simply price out, or they'll start to price in demand destruction to balance the market. Uh,
Or cold. Obviously a cold northern winter is the.
or yeah, cold people, but that's the same thing. as
Oh no,
dem-
sorry. I was saying, yeah. So you spoke about La Nina being. It's in terms of weather.
oh yeah, or
There's
just
a
a
weather
plain
shock to.
cold northern
There's
winter. Yes,
Yeah, sorry.
absolutely.
There's a weather shock to supply, but there's also a possible weather shock to demand as well in terms of
Oh,
you know
absolutely.
and,
Yes,
and and part of it is if the cold winter's across the middle of Russia where hardly anyone lives, then it doesn't make a difference. But if the
yes,
cold winter
quite
is
right.
a few hundred kilometers or whatever further east or west, and
Yes,
next thing you know, it starts affecting big population
quite right.
in China or in Europe.
So today we're in this febrile situation where it's volatile. Um, Nonetheless, we maintain that this is a cyclical problem, not structural, as pretty much Wall Street is arguing that it's structural, and I think rather cynically to blow a big fat bubble. So anyway, that's what it does. So how does it resolve? Um, we think that this extremely elevated goods volumes that we're seeing out of the US will just slowly diminish as it reopens to services and spending gets reallocated. Uh, um, there may be, there are going to be other economies opening and closing, and it's really, really impossible to predict precisely. But we think that the spike has been so full on out of the US that uh, it is likely, in net terms, to diminish over the next 12 months. So that impact should wane steadily. Um, Chinese coal is already booming on the back of crazy prices and official intervention. So the low they reached during their little perfect storm was a month or two ago at about 10.4 million tonnes per day output. They're already back to like 11.6, and they're going to get it to 12 really quick. I think certainly within 6 months, probably three. And so I just think thermal um, thermal coal is going to crash. In fact, it has crashed over the last 2 days. It's been slammed, and I think without weather intervening, I think thermal coal's in real trouble already, basically. So I think that bubble's going to pop. As I just went through with coking coal, I just think demand for coking coal it's been absolutely clubbed, uh, and it's kind of been rising in sympathy with thermal coal, because maybe you can use some better quality coal if in power generation if you need to. Certainly been a massive speculative element, and hoarding has piled into both these markets. But the the wonder of that is that it's pro-cyclical, and if the market gets a sniff that this is turned, then all of that will unwind really fast. And so that's why I expect both coals to crash. It may not be now, it may be New Year, it may be February, but I don't think it's going to take long. I think coal is in trouble already. Um, Gas, as we've discussed, is a little more complex because it's just very difficult to determine political decision making. But as we've discussed, there are some constraints on how hard Russia can push. And one of them, probably the main one, is US in LNG into Europe, which it hasn't really resorted to yet, but it can. And so, at a certain point, I guess there'll be a deal done there. That one's a bit in the lap of the gods. But the one thing we should factor in is if coal starts to break, it will break gas, because they're effectively the same trade. Like both produce electricity, and so you can rotate from one to the other in your grid when need be. So if coal really starts to come off, it will be difficult for gas to be sustained at extreme price levels. So in other words, we expect the whole thing to come a cropper pretty quickly. Now this has a flow on into all kinds of different investment markets. We've been arguing all year that we will be seeing a commodity rout coming out of the COVID reopening. We this energy bubble pretty much came out of the blue. Even the Wall Street bulls were not predicting coal and LNG to suddenly take off. It's not something that we foresaw, and as I say, I really do think that it is a, a bit of a perfect storm. So I think it will pass relatively quickly. But for the time being, what it's done through, as we mentioned before, is uh, uh, it's created some demand destruction in China already because prices have gotten so high, and the main component of that has been cutting metal supply output, and so that means all metal prices have started to rise and blow off with the energy prices. But once you start to see the energy prices come off, then of course that goes into full reverse, and China can resume a lot of that metals processing, and so those things that have gone up in sympathy with energy should come straight back down with it.
Yeah, and keep in mind a lot of that's the cost of it's a refining cost that's blown out because people just can't get the capacity. So you've got
Yes.
your copper or your aluminium or whatever coming in at one end, but the factory's shut to refine that into the final metal. And so
Yeah.
it's not the issue that the copper ore that's coming out of the ground is all of a sudden in great demand. It's actually the other end, the refined copper is the part that's in great demand, and yeah, you're not necessarily if a lot of copper companies outsource that part, and so yeah, you're not necessarily buying copper miner and picking up all that gain.
Yes. So the point is, you've got a whole bunch of these pro-cyclical forces that simply roll over. Well, cyclical up, rolling over when energy does, and becoming pro-cyclical down. And then on top of that, there's a convergence here of a whole bunch of things that aren't very good for commodities, which is, the Chinese property bust is still getting worse. We've now seen the People's Bank of China, the PBOC, come in last weekend and pull a Bernanke and tell us that the property developer shakeout is contained, and it isn't. Um, it has managed to sort of talk down some spreads for this in the short term, but it still looks to me to be the cat looks out of the bag to me, and principally the principal reason for that is there's been no change in the regulatory environment, which is really driving it, and a political or calculus still seems to be to use this huge export boom to deflate property, especially the developers, not necessarily property prices, although they have started to fall, but certainly to demolish the developer sector, which has simply gotten way out of control in China, and so that remains on track, despite the PBOC reassuring that it's going to try and keep credit stable. The authorities, for instance, last week launched a new anti-corruption program through the financial regulators and the bank and the banks dealing with the developers. And so the developers just have all sorts of funding problems from spreads through banks through falling sales because the market is spooked. And so property in China remains frozen, somewhat frozen. And it doesn't look like they've done enough to stop it to me. So all of this energy bubble and bust, I think, converges with that. And as we forecast for all of this year, US growth is also sliding really fast. Even though the goods demand is still there, its overall growth is coming off all of the huge growth rates, and we still expect that good stuff to slide away. And most critically, not just in terms of growth rates, but actual volumes. That's what matters to commodities. So that's what we think will happen over 2022. And then, as all of those things happen together, then you're going to get an easing in the supply side bottlenecks that we've still got going. There's some amazing material floating around at the moment on US ports, and how they're seeking to manage, this incredible kind of volume spike of the inflow of goods, and how jammed up they all are and what they're aiming to do about it. And it's everything from, using smaller boxes and packing containers more than they used to trying to work 24 hours a day. But it's like a traffic jam at the moment, where everybody's slowed to a crawl. Nobody really knows what the answer is to the tailback. It's lots of little things, but at a certain point it clears, and then suddenly it doesn't just go back to 60 kilometers an hour, it goes up to 100, because you've created all these efficiencies while you were, in the congestion, and so everything works twice as well as it used to, and your prices suddenly crater. And so we see that coming as well.
And,
And
and, and I guess keeping in mind though that it's really hard to tell whether it's going to clear.
it
Even
is.
um, the in
Well,
terms of people
yeah.
analyzing traffic jams is a great example because you know uh, nobody really knows exactly what the cause was that tipped it from everyone going 100 kilometers an hour to everyone dropping back to 15,
Yes. Yeah. The
and
tailback is one of the great mysteries of the modern universe.
yeah, and
Yeah.
you can never really tell as well that what then all of a sudden clears it, and next thing you know, everyone's back going at 100 again. And
Yes.
so, yeah, knowing that, I guess there's this thing about saying, well, will goods demand stay so high forever and just keep growing, and we'll never be able to catch up in terms of capacity? And we're going, well, no, we don't think that's the case. We think it'll be a mixture of improvements in processes and that whole goods demand coming back to something more normal that just,
Yeah.
and when it frees up, we fully expect it to free up quickly.
So you got a convergence of all these deflationary events, but for the time being, the dominant narrative coming out of Wall Street and kind of monetary narrative in the US is stagflation. uh, as these supply side impacts limit growth and prices go up. We don't buy into that, but the point is that the Fed is kind of being spooked into tapering at this point, because you've got you do have lots of heavily distorted markets by this free money, and there's lots of people arguing now that this inflation is embedding and becoming structural. And so the Fed looks like it is going to taper, and that's probably going to give us a reasonably strong US dollar, which is another headwind against all of what that adds to the pro-cyclicality on the downside that we're talking about here for 2022. So we're not saying this happens overnight, and we don't know. There's lots of um, um, unforecastable things in precise terms, but in general, when we look at 2022, we can see how this energy bubble bursts relatively quickly and then tips into a whole range of things that then deflate, and we end up, 2022 being a year of quite sharp deflation, not inflation, because you have to remember all these prices right now are not just rebounded from COVID lows; they're actually really, really high. And so if they come off and head to anything resembling normal, then 2022 will not just be zero inflation; it'll be deeply negative. Uh, across all of the supply side strains that we're seeing now. So we just think that that
So
happens. But
having said that, so we're talking about a deeply negative producer prices,
yes,
not
yes,
not
yes.
not not consumer prices.
No,
Consumer
that's right.
prices will be
Yes.
lower, but we're not expecting, yeah, deep
Yes,
negative
yes. No,
consumer
no, and
prices.
there are other obviously other things that working into the CPI, but basically as that happens, markets will start to price the CPI pressures diminishing over time as well.
Mm.
But yes, we're largely talking about producer prices. So, uh, at the moment, we've got a yield backup going on globally, and as markets kind of spooked by all of this and looking, starting to price in stagflation, or at least inflation, if not stagflation, and that's starting to do a couple of interesting things to other asset markets. The Australian yields, for instance, have outpaced the US, and we've reverted from, we were at a discount. We're in a negative spread to the US earlier this year, but it's now positive, and that's helping to lift the Australian dollar as well as commodity prices. However, um, again, we don't see that lasting. We think that as these various short-term distortions come out and begin to deflate, then the current yield back up will roll over. Certainly at the long end, like the further that we get into a Fed taper, I think the markets will eventually. We had a bit of a taste of it this week, but we'll get more of it. The curve will start to flatten pretty quick, because markets will simply start to price in that all of the tightening will start damaging growth, etc. So at the moment, going along with that yield back up, we've got a bit of a rotation, not much to be honest, but some where value has led growth again for a few months, which is kind of a reversal of what we've seen for the last maybe 3 or 4 months. But growth is still doing okay, to be honest. Tech bid's still there, even if it's corrected somewhat. But the thing is, if yields roll and this whole deflation starts to happen, and it is accompanied with slowing growth, and in particular China really struggling to come out of its property correction, then we still think that a broad-based stock correction is the base case. So we wouldn't be immediately rushing back to growth from value either, but we would maybe probably buy it on a correction. And at the moment, we're still very short miners, and we're out of banks for the same reasons, because they're cyclical plays, and we see this pretty extraordinary kind of cyclical blow off in growth and prices and commodities and the whole risk on complex, if you like. We see it all reversing next year.
Oh, just couple of quick questions.
Yep.
The last energy price boom, food commodities, rice, wheat, edible oils, etc., began to rise because corn prices rose and ethanol and the cost of production increased. We're going to see the same thing happen again.
We're seeing some of that already, and so in the short term, maybe, but I wouldn't be too worried about that in the long. I mean, the other factor that in food prices that's always really can be very material is a La Nina, because it changes rain patterns everywhere. And when I was talking about Cyclone Yazi, I think that was during the same La Nina that gave us, the Arab Spring, and everything, when all sorts of grains prices went bananas. So I mean, I don't track particular grains in detail, so I can't really comment on where they're at. But I'd probably be more concerned about La Nina having a short-term impact than I would the energy bubble, because I think the energy bubble is going to deflate, so I don't think that'll be a big deal long term. And then you're really in the lap of the weather gods from there.
Yep, absolutely. Um, that's probably about it. I'm not sure if anyone else want to drop in any questions. If anyone's got anything in particular they wanted to follow up on, I'll give that a quick minute or two. So, is there anything else, Dave, you wanted to run through?
No, that's about it.
Side?
I'll just I guess I'll just add that I've tracked commodity markets for well over 20 years, and I have to say some of the pricing I've seen in the last month is really crazy stuff. Like
Well,
it's the craziest I've ever seen, and I wouldn't discount even a psychological element in this, being in the post-COVID environment. Like, everybody's a bit nuts at the moment, and including people. Markets are made up of people, and so we've had rolling bubbles through all sorts of markets during this post-COVID recovery, and I think that's really the context for this. I don't think it's the long-term ESG stuff. I actually think it's more just crazy humans.
Yeah, and supply shortages and
Oh,
supply
yeah, yeah,
chains
yeah, yeah.
messed
Oh,
up
absolutely.
and
No, no, don't
yeah,
get me wrong. There is a
all right.
kernel of
Mm,
truth here, just
mm,
as there has been, like in the tech bubble we saw earlier in COVID, right?
mm,
You know, when we saw the K-shaped recovery, there was a kernel of truth there. But then, why are you buying profitless dog tech and bidding it up to infinite multiples? You know, when
yeah, yeah, yeah,
that's
absolutely.
that's there's a kernel of truth in all these bubbles.
Yeah.
There's a kernel of truth in the Bitcoin. You know,
Mm,
in blockchain and its uses, etc. It's just once Wall Street gets a hold of it, you know, Wall Street's real role is not to analyze; it's to sell.
mm.
So it sells.
Yep. And I mean, the other thing to note as well, just in terms of that whole demand supply imbalance, is that the biggest consumer of almost every commodity around is the Chinese building market, and that's going through this
Yeah,
massive uh,
yeah, yeah,
slowdown.
yeah.
And it's the irony of all ironies that as
Well, it is.
lots of other
Yes,
commodities rising
yes,
as the world's
yes.
biggest consumer slows down and doesn't look like
Yeah,
in
that
any way speeding
is
up.
that really is just the nub of the crazy. Like,
Mm.
that's amazing. Yeah.
Hmm. So just got some questions around along the Aussie dollar. So how long before it goes south, and how far north can it go before it does?
Well, it's been at record short positioning, so I mean it's vulnerable, as we've said many times, to a big squeeze, and that we've got that underway.
Which pushes the price up, pushes the Aussie dollar
Yep,
up
yeah.
versus other
So
cryptos.
I don't know, but but I mean, we'll put it this way: we pulled off some of our US dollar hedges and haven't put them back on yet. Um, uh, I would have thought anything up at 78, I'd be like going in with both hands. But it may not be to get there. I mean, as I say, I think the coal dimension to this looks like it's in trouble already.
Mm.
So, I
But
mean, again,
there's
it
it's the
also,
weather thing as well, isn't it? It's this
well, and
you
then
get
the
these weather
weather's
events.
yeah, the weather thing is the real problem to
Mm,
say anything with uh, any confidence. So, and that probably takes you to the end of January. Um, but what I would say is, given our outlook, is the spike is hopefully it flushes out a lot of those shorts, and then the spike will be a fantastic opportunity to
mm.
buy offshore stuff.
Yeah. And I
So,
mean, net effect is anyway, look, for anyone who's a longer term, investor, is we're expecting it to be well lower than where it is today, in 2 or 3
well,
years'
within a
time.
year,
Yeah.
yes,
But this question is,
absolutely,
does it rise first? And there's a
yeah. Because I do think one thing markets have got completely wrong is the RBA. Markets are already pricing in rate hikes here in next year, I think, maybe the end
yeah.
of next year.
Mm,
And I just think there's Buckley's chance of that in Australia. I mean, maybe on the outside chance that we get zero immigration, we might be starting to talk about it in 2023.
mm,
But Australia just got so many tools that it pulls, or levers to pull, that it does all the time deliberately do so to embed deflation and keep house prices high, including macroprudential now as well. That I just think the market's got the wrong end of the RBA stick completely. Uh, and there's all this talk now. There's a federal election coming. There's talk of an RBA review, and that review is going to be all about how it failed to generate inflation. Is it really going to pile in at this point with rate
mm.
hikes? I mean, I think
Yeah.
that I think the market's very wrong on that. Um, uh, sorry, where was it? What was the question?
It was how far can the Aussie dollar rise before it falls? So yeah.
All right. Yeah. Well, so in short, yes. I just think
Mm,
a year out, yes, with
yeah.
that kind of outlook for the RBA and potential
Yep.
commodity
And,
falls and Chinese property and
and that
yeah,
that extends, that extends to most of that investment view. Really, is that it's that similar thought as, look, that we think the direction is down for a lot of these, but It's not impossible that you could get a spike higher, and if you get the
Yeah.
wrong sequence of events, the spike higher could be really big.
Yes.
And actually, keeping in mind though as well, most of the effect you're seeing in these commodity prices isn't flowing through to stocks anywhere near what the increase in price is.
No,
So
at
yeah,
all. That's
no,
really that's really something. So that's telling you that I mean, I guess the stocks are following the futures market really,
mm,
and they're just saying that this is temporary.
yeah,
And
excellent. Well, I think maybe on that note we might leave it there, Dave.
yep,
Um,
good.
Thanks everyone for listening in. Don't forget to click that like button. And if you know anyone else who might get something out of today's episode, we'd love you to share it with them. If you want to see any more of any of our previous webinars, head over to nucleuswealth.com/content. To stay up to date with news from us, you can follow us on social media. We're on Twitter, Facebook, LinkedIn. Most of those we all have something on. And thanks again for tuning in. From myself, David, and the rest of the team, we'd look forward to seeing you at the next one.